Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold, copper and uranium in a separate video. I'll leave a link for that in the description section below. I'm also going to tell you what I'm doing with my SP 500 positions, so make sure you stick around for that. As always, this is general commentary, doesn't take your personal situation into account. With all that said, let's jump over to our first chart. So I got the S&P 500 up on the screen, and a lot has happened in this past week. What we've seen over the last few days is the S&P initially had a shallow bounce off this key support at 4,200, and then it all gave way. 4,200. It's been a key level over the pretty much over the last year. You can see how it's been this technically active region. So this break that we're currently seeing, I think it is a really significant event that we need to pay close attention to. The last couple of months, I've been saying that the most likely scenario, in my view, had been that this pullback from the July high. I've been saying, look, I think this is a pullback within an overall rising trend. And my take has been that the play has been to remain cautiously long. And I didn't think this was part of a larger reversal. But I think the key with any good trading process is that we always have to keep assessing the price action as it unfolds. And I think the situation as it stands is the S&P 500 has it's just made a new low. It is below declining moving averages. Those moving averages are also starting to cross and turn to the downside. And we've spoken about the vulnerabilities over the past few weeks, that the market has been below these moving averages and that breadth has been deteriorating. So there've been points of vulnerability, but vulnerability doesn't trigger a sell signal on its own. For me, the sell signal has been the break below this key support area at 4,200, and I think the break of the October low just this week, I think that just intensifies the vulnerability that we do have in the S&P 500 at this moment. We've also got a clear break from this trend channel. So this trend channel goes all the way back to the October low last year. Nicely defined channel, edged below it in early October, rebounded, but now we do have that clear break. We are getting a little bit stretched below these moving averages. There's probably some potential for a near-term bounce, but really I don't want to play with that whatsoever. Breaking this key support level, I think it's a big deal, and I think it's a case for just taking extreme caution, not trying to buy any potential bounce from an oversold position. We've got to see how this plays out now. The support's broken. Is there going to be follow-through selling? How much follow-through selling will there be if the follow-through selling emerges? And that will give us more clues as to what the direction going forward should be. Just taking a quick look at the Nasdaq, and the hope was, well, at least my hope, I'm sure the hope of many who have been looking at the charts, was that this was going to be a bullish flagging formation, which could resolve to the upside. But look, I think the hopes of that are now well and truly dashed. The break to the downside of this pattern really does rule out that possibility. It's now what we have now. It's now taking the form of a sequence of lower lows and lower highs. And when you get a market coming out of one of these patterns, they can come apart quite quickly. They can turn into like a cascading type pattern. And I'm not suggesting this is what's going to happen on this occasion, but they can turn into these cascading patterns where they continue to accelerate to the downside. So I'm not saying that's going to happen, but that's the risk when a market starts to roll out of a lower low, lower high sequence, like which is currently structured on the chart. So I think we've got to got to really respect risk at this point in time. It is a vulnerable period, and as I've been saying for a while now, I've been selling stocks that have been breaking support, that have been hitting their stops. It's not a time for holding and hoping that things stabilize and go back up. I think it's a case of really having to protect capital when stocks go into reverse. Not all stocks are in reverse. Some stocks are still rising. They are still in uptrends. I'm happy to keep holding them, but I want to shut down risk where it's just becoming too great. And my S&P 500 position, if you've been watching these for a while, you know I bought an S&P 500 position a while back. I bought it, it was back here. It was back here on the 14th of October. It was after this CPI day. We had this key reversal day. The market broke lower, no follow-through selling, snapped back higher. For me, that was an entry signal with a relatively close stop loss. I thought it was relatively low risk for good potential upside. I've held that position for the last year. And this week, I sold it. I sold it as this market started to break down, and it's been a great trade. But well, look, it hasn't been great. It's been good. It's been a good solid trade. But I'm not going to continue holding, hoping that this market is going to reverse. It's really interesting. I had a comment in the after last week's video. So I had been saying that I thought about exiting my position a week earlier, but I decided to hold off. It was as the market was breaking below the trend line from the channel, approaching support. I thought of exiting a week ago, but I held off because the market was above 4,200, and I got a comment saying, incredibly brave of you to be holding all this way down. But then question my risk management. Like, am I managing risk appropriately by holding a position declining from the high? And my reply to that was, it all depends on your time frame, what you're looking at doing, what you're trying to achieve. If you're a short-term trader, holding from this high would not be a sensible strategy. I'm holding from much further back, and I've been taking a medium-term approach to my positioning. I'm holding onto an indice which had the potential to rally over a year or maybe 2 years, whatever it may be. But it's a medium-term approach to trend following that I'm doing. And if you're going to take a medium-term approach to trend following, you've got to be able to see off moderate pullbacks, or you can never ride a big trend. And it's that approach to managing risk that made it possible for me to see off these pullbacks in December last year and February this year. And if you can't see all of this type of pullback, you can't stay with larger upward trends. So this is only just becoming a double-digit pullback now. You've got to be able to see off single-digit pullbacks to stay on trends, because you look at uptrends and we've got pullbacks all the time. You've got to be able to see them off. But not every trend turns into a big trend, and you've got to be prepared to surrender some of your upside to stay on a larger trend. As it turns out, my gain, saying I got in, just midpoint, because I'm not exactly sure at this point where I got in, just today, the 14th of October. It was, say, a 27% gain at the highs. At my exit point, it's a 16% gain. You always give back some at the end. You never hold on to the whole profit if you want to ride trends. It's just the way it goes. But as things stand, I think it's now time for caution. I think it's a time for keeping a tight rein on risk. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. It just tells YouTube you're watching, and YouTube shows other people, and that helps me a lot. So please do that. Now, let's quickly just move on to a couple of other markets which are important this week. The Russell, the small caps, the Russell 2000. So big things going on here. Broke support at around 1,700 on when was that? On Friday. Friday it broke through, and then proceeded lower through the week. We're now testing the lower support of this big range. this big range which has persisted since June 2022. So almost, what's that? It's probably about 16 months. And we're testing the lower boundary at around 1,650. We're within a whisker of making a new low from October last year. And at this point, it just seems inevitable that that's going to happen. This is now stretched below these moving averages. So as I was saying, in the SP 500, there's I think a reasonable chance that we do get a rebound, a near-term rebound, but I'm not looking for that to produce much. I think, as I say, the path of least resistance is lower. The moving averages are pointing down. The 50 is below the 100-day. It's lower highs, lower lows. It's a structural downtrend any which way you look at it. And I do think now you've got to say this range is going to break. So I don't want to be trying to be too clever and buying on support and getting a little bounce and getting a small profit. I think there's too much risk in doing that. And also remember, this is a really big range. Should this break to the downside, so it hasn't officially broken at this point, so you can't completely be sure, but should it break to the downside, breaks from big ranges tend to follow through. Doesn't always, but that's the basis I think then we've got to work on. So it would do a lot of technical damage. And it's again, as I say, it's time for shutting down risk, not for putting it on. And one last thing I want to look at, it's the iShares and microcap ETF. Haven't looked at this for a while, so it's interesting. The smaller you get, the smaller stocks you look at, the worse position they appear to be in. So this is already broken lower. And these lines I have on the chart, I had this on, we were talking about this, it might have been back in July. I had hopes that maybe this was some sort of a large bullish wedge formation, part of a large bottoming formation, but that hasn't turned out to be the case. Broke below the moving averages in August, the moving averages crossed, we've been trending lower for several months, and now we're below the lower boundary from what was once hoped to be a constructive technical structure, but that hasn't proven to be the case. So, as these stocks get smaller, the more technical damage has been done. Every bear market will bottom at a state of, usually you're looking its worst, below the moving averages, but we don't know where that's going to be. We don't know when that's going to be. So I think the strategy is not to try and preempt where that will be. As I say, we just need to play the hand the market is dealing. And at the moment, I think it's about protecting capital, not trying to pick low points. So look, let's leave that there for this week. Hopefully that's been interesting. Thanks for joining me. I look forward to coming back and talking to you next week. Till then, bye for now.